What gave you that aha Coca-Cola moment in your investment career to adapt, go from deep value to the Munger approach to investing?
For us, the biggest eye opener was back in the 1980s when cable TV systems, the public companies were losing money, they had negative book value, and yet we saw this consistent private market develop for cable systems where they were selling either to private equity or to other larger cable companies at about 11 times EBITDA. And the question was, what was going on between that EBITDA line and the net income line that didn't reflect real world economics? To us, there were two things. One, it was wires that were in the ground were being depreciated over 5, 6 years. Their economic life was probably 3 to 4 times that long. So depreciation cost was way more than economic depreciation. Secondly, this was at a time when cable TV systems were growing very substantially. So a lot of money was being spent on customer acquisition. Once a customer was acquired, they tended to stay with their cable service until they moved, and then they would immediately seek out the new cable service for their new location. But those customer acquisition costs were going straight through the income statement. When we adjusted for those two items, we thought that a lot of public cable TV companies were selling at barely double-digit PE multiples despite pretty rapid growth and good free cash generation.